Hello to everyone on the Zoom call. This is Stelios. Welcome to the new normal. This is a hybrid meeting. I'm zooming in like all 24 participants I see. Thank you for being here. I don't think they can hear us yet in the room. But Nikos Papapostoulou will probably stand up in the next couple of minutes and welcome everybody in the room, and then we can start. I can see Nikos Papapostoulou in the room, in the conference hall. Nico, can you hear me?
Yes, I can, Sir Stelios. Shall we start? Are we ready?
Why don't you start by welcoming everybody in the room, and then I'll say a few words.
Καλησπέρα και καλώς ήρθατε. I'm Dr. Nikos Papapostoulou. I'm the director of the MSc Simple Trade and Finance at Base Business School. On behalf of the school, I would like to welcome you at tonight's event, which is about the Stelios Philanthropic Foundation scholarships provided to the school. I'm not going to keep you longer. I will pass it on to Sir Stelios Haji-Ioannou, the founder and president of the Philanthropic Foundation, creator and owner of the Easy family of brands.
Thank you, Nico. Again, for those in the room, very welcome to our brand new, recently renovated conference hall in Plaka in Athens. I'm sorry I couldn't be with you this evening in Plaka. I'm sure you'll have a great time and you'll have a drink after we finish the Zoom. But for now, all I can do is say a few words over the Zoom and you know, see the video from the room, which looks nice. A few words about the space you're in. This property was purchased by partly because of the financial crisis in Greece and other things. We didn't actually manage to renovate it and open it until 2023. So you are one of our first events. Many of you, especially older people like me, may remember Cine Paris, which is the open-air cinema which actually operates or used to operate at the rooftop, at the roof garden of the same building. Again, the foundation has rented the space out to an operator of open-air cinemas, the Bechtzis family in Athens. And I believe they were going to start operating the open-air cinema from May this year. So you may like, on a social basis, to come back and visit the space upstairs one evening for the open-air cinema. In the meantime, what we call the conference hall, which is the space you're in now downstairs, we make available to other charities, other not-for-profit organizations like the university, to organize their events for free. So we're not trying to make money out of the space. We even help them with catering and production costs. So if any of you are interested or know of any other charity in Athens that would like to host their event, would be delighted to hear the proposal, and if they're a worthwhile charity, we'd love to host it for them. You are here presumably because you're interested in our scholarships. So I assume you are very promising young people in the room who would like to go to London and study. I can't help but remember that the reason I went to the City University, as it was then, the City University Business School, it was called, in 1987, is because in my teenage years in Athens, I had met Professor Kostas Gramenos. And as you know, Professor Kostas Gramenos is an institution in London and in the world of universities and education. So Kostas somehow spotted me and he said, one day you will come to my course and study in London. I said, yes, sir. And the other thing I believed back then is that a course in shipping, trade, and finance is exactly what I wanted to do, because I was going to work in my father's shipping company for the rest of my life. And of course, none of that came true, because not only I resigned from my father's company, and with his help, and I'm always grateful to my father for the financial help he gave me, he started another shipping company, but then I started the Easy family of brands, the most famous of which, of course, is EasyJet. And the rest is history. I would like now to take 4 minutes of your time to play a video we've recently created for the 30th anniversary. So this journey with the Easy family of brands started in 1994, when I was 27 years old. And 30 years later, as you will see from the video, it has created a nice recurring predictable income stream for my company, the company I call Easy Group, which in turn we use to fund the charity work of the foundation. So Easy Group is my own company. The majority of its profits we donate to the foundation that gives all the scholarships, but also does a lot of other good work. For those of you who live in Athens may have heard of our Food from the Heart program, where we literally give free snacks to people who come and ask for them. And many other projects, including rewarding young entrepreneurs, both in the UK and in Greece and in Cyprus. So without further ado, rather than me trying to say these things, I'd like to project a 4-minute video. It will show you, if you like, where the money is coming from, the Easy family of brands, and how it's being spent for the good cause. And then I'll say a few words and then probably zoom out and allow Nikos to run the rest of the evening. Can we please play the video now?
From one rival, EasyJet tried to hijack the launch, arriving in their distinctive orange uniforms as customers.
If If you think the airline was crazy, listen to this.
Okay.
I believe that the internet is going to take off. More and more people will need to use the internet.
Come fly with me, let's fly away.
So you can get it if you really want to. Shine, shine like a star. Shining so bright, like the star that you are. Oh, shine into the future, spreading your light wherever you are. Oh, shine, shine your light. Shine your light. Shine your light. Shine your light. Just about on there. Imagine when no warrior, call it a destroyer. Human, simply the best. Nobody that can touch that. Name first, kiss to say, nobody that can catch me. Moving like lightning with no energy. Shine your light. Just about on there. Shine your light. Just about on there. In my flow like a butterfly, the earthling man. Yes, me a jackboat, calling your son. The crowd is roaring, hearing my story. Holding on to them are the champions they win. What they say that never make it. I found strength from within. Cause it is there if you seek it. So you can get it if you really want to. Shine like a star. Shining so bright, like the star that you are. Oh, shine into the future, spreading your light wherever you are. Come on and shine like a star. Shining so bright, like the star that you are. Oh, shine into the future, spreading your light wherever you are. Oh, shine.
So I hope you enjoyed the video. I have to admit the audio on Zoom was not great. I hope it was better in the room. But if you'd like to, for those zooming in who didn't enjoy the sound as much, perhaps you can go back to YouTube and check it out, or go to easyhistory.info. I never cease to be amazed that we managed to find in about a month 6.3 million views on YouTube. So I always wonder who are these people, but it's very nice to see that we're receiving attention and 6.3 million views on YouTube in a month. So hopefully now you have a better idea about my for-profit company, Easy Family of Brands, and then how we give back to society through the foundation. I'd like to think that nowadays I have a time allocation of roughly 1/3 for the Easy Family, 1/3 for other investments, unbranded investments, stock markets and things like that, and then 1/3 for giving back to society. So for me, it's very important that I'm here, that we encourage young people to go to London and study, improve themselves, and then come back and create jobs and wealth for themselves and businesses and improve their own countries. So I don't have any other remarks, Nico. I'll hand it over to you unless there is any burning question in the room.
Any questions that you would like to ask Sir Stelios? No questions.
All right. Thanks a lot. Bye-bye. Enjoy your evening.
Thank you. Let me begin. I have a presentation as well, but let me begin by extending our gratitude to Sir Stelios for the continued support to our students. I'm going to share with you a few facts about the scholarships. Sir Stelios Haji-Ioannou joined City University Business School. This is the name of the business school back then. He joined the MSc in Shipping, Trade and Finance back in 1987, and he graduated in 1989. The first year of scholarships was 2006, and since then, the Philanthropic Foundation is gathering all scholars on a yearly basis for a reunion. The first reunion took place in 2016 in Monaco. In 2017, there was a new agreement that was signed between the foundation and the school. The new terms included a program lead which I ran the position, and some extra promotional funds provided by the foundation in order to promote the scholarships and any other extra curriculum activities. And 2014, we have a new agreement with the foundation. Since then, each scholarship worth £10,000 towards the fees. The new agreement is for £20,000 each scholarship that counts towards the fees. So far, the foundation has donated £1.42 million and another £60,000 for the program lead and for promotional purposes. 142 scholars. The reunion now is taking place at the headquarters of the foundation in London. What we're looking for when we select the applicants that the scholarship will be awarded to, we're looking for academic excellence, some evidence of financial need, EU or UK citizens, and some promise of continued growth. So this lays out the timeline of the scholarships and some basic points of what we're looking for and some facts of what has been happening with the scholarships and the school so far. In terms of timeline, the scholarships are going to open tomorrow. There is an online application. People or applicants, they need to be offer holders on a program which is finance related or entrepreneurship related. Then there is a deadline beginning of June. There will be a shortlisting done by the admissions office, and then unsuccessful applicants will be informed. The shortlisted applicants will be called for interviews, and thereafter I will convey my opinion through the interviews that I conduct to a panel at the school, which consists of the dean of the school, the associate dean for all MSc programs, and the head of admissions. And then the final decision will be conveyed also to the successful applicants. So this is more or less the timeline that we have in terms of process and how we select the successful applicants. I don't know if you have any questions that you would like me to answer now. If not, what we have decided as well, since we have here people that are interested in studying on a program at Base Business School, I'm going to give you a sample of a lecture of what we are doing at the school. I'm going to try, in the interest of time, I'm going to try and keep it short. More than welcome to interrupt me if you have any questions throughout the presentation. Obviously, I'm on the MSc in Shipping, Trade and Finance. Therefore, I will try to make the presentation finance and shipping related, if you don't mind. So we're going to talk about public equity financing. Some basic facts about financing, main sources of finance. We have the equity, we have the mezzanine finance, and we have also debt. In terms of equity, we have the owner's equity, retained earnings of the company, and then we move to public or private placements, equity placements, or private equity. Debt, we have bank finance, export finance, bonds, whether we're talking about public or private placements, leasing, and then in the middle we have the mezzanine finance, which includes preference shares. It includes also convertible bonds and warrants. Raising equity, this is what we'll focus on tonight. Raising equity can take place through initial public offerings. This is a method that companies will use in order to go public for the first time. So they're offering their shares to the public for the first time. After that, they can utilize the same source for a second time through a follow-on offering. Then we have the SPACs. That's a different story. What we have here is companies that they go public with the intention to merge or acquire a target. And then we have the ATMs, which is the at-the-market offering. This is a method that companies can utilize when they're already publicly listed, and they can make offering of shares of their company again to the public but there is a difference between the other methods in terms that you do not need an underwriter, which I will discuss in a few minutes. Main reasons to go public, obviously for growth purposes. The company needs to grow in size, therefore equity financing is an option for companies, rebalancing leverage, enhancing the liquidity of shares, and of course, companies will go public because they have a very good story or project to sell to investors. Some advantages and disadvantages, the reduction of financial risk. This is one of the main advantages that companies will have if they go public, because they do not have any debt obligations, like in the case of a bond offering. They may have to distribute dividends, but they are not obliged to do so. Therefore, we have the reduction of financial risk, and of course, enhancing share liquidity. In terms of disadvantages, we have loss of managerial control, purely because the company will have to offer shares to the public, therefore they will lose some control of the company, and we have high costs as well. High costs not only for the company to go public, but also ongoing costs when the company is public as well. So they will have to pay, let's say, for disclosure, information disclosure, they will have to pay legal fees, they will have to pay auditing fees, they will have to pay also PR fees as well in order to attract new investment to the company. Key players in the whole process, we have the advisors, we have the underwriters, which the underwriters, they will form the syndicate. In the syndicate, we have the underwriting group, we have also the managing group, and we have the selling group, three distinct groups within the syndicate that they have different tasks to perform, company, and of course, the investors. A few words about the IPO roadmap, what is the process, and what are the different tasks that an underwriter needs to undertake. We start with the initial step, where the company will appoint advisors. They will consult the company in terms of who is the best underwriter for their case. Therefore, then we'll have the selection of the lead managers, the formation of the syndicate, and then the letter of intent, which is very important. The letter of intent will lay out also the fees of the underwriters, and it will include also an over-allotment option granted by the company to the underwriters. We will talk about the over-allotment option as well in step 5. Registration is the second step. Obviously, it is illegal to offer shares to the public if they're not registered with the relevant financial authorities. In the second step, the underwriters, they have to make sure that the public has accurate information with regards to the offering, and that's why they will perform the due diligence. And thereafter, we'll have the preliminary prospectus. Preliminary prospectus is the same as the final prospectus, with the only difference on the cover page, it is written with red letters, preliminary prospectus, and that's why you may come across the preliminary prospectus as the red herring as well. Step 3, which is very important, it is the marketing step. What will happen here is the company, alongside the underwriters, they will go out and present the company to the public and potential investors. So we have the roadshow and the book building process. The task of the underwriter, as you can see in step 4, is to price and allocate the shares of the company, but at the same time is to create the demand. And that's why through the book building process, it is very important for the underwriter to get a flavor or capture the expected demand out there for the particular issue. What happens through the book building? Underwriters, they will provide investors with an indicative price range, and then investors, they will start bidding for different numbers of shares at different prices. These are not legally binding bids, they are only indications of interest. But it gives the opportunity to the underwriters to capture the demand for the particular issue. Step 4, we have the pricing and allocation. Pricing of the issue is both science and art. However, the science part is not so important because underwriters, they will all use the same valuation methods. They will use also the same comparable companies. What is important in the pricing of the issue is the art part. And the art part is the ability of the underwriters to create the demand, but at the same time capture the demand out there for the particular issue. This will assist them as well later on in order to price the issue. Then we have the allocation of shares. They have to be careful where the shares they will end up. Therefore, they will look to allocate the shares to long-term investors rather than speculators. And after that, the company will go public the next day. Final step, step 5, we have the aftermarket activities. 40 days after the company will go public, research on the particular company can be initiated. This is when the research analysts will come out and express their opinion with regards to the particular issue. The company can come out as well and provide different forecasts. But what is important here is the stabilization. When the company will go public, depending on the pricing, the final offer price set by the underwriters, then the shares that will start trading. Underwriters, one of the tasks of the underwriters is to stabilize the aftermarket performance if there is a huge decline a few days after the company goes public. It's perfectly legal for the underwriters to do so by going out in the open market and purchasing stocks of the company back. How this happens, they can initiate a short position at the time of the offering, purely because they have at their hand the over-allotment option. So what they can do is they can borrow shares from the company, an extra, let's say, 15% of shares from the company, sell them to the public, and this will give them also ammunition if they try to stabilize the share price performance of the stock thereafter. So in order to close the short position, I don't know if you know how short position works. I'm not going to go into much detail, but if you initiate a short position, it means that you are selling something that you have to buy back later on. That's how you cover your short position. This is what the underwriters will do in the case that the shares will have a decline in the first few days of trading. Obviously, the underwriters in this case, they will make a nice profit as well, but this is something that it is agreed between the company and the underwriters, where the profit will go. Purely because, for example, if the initial price offering was at $10 and then the shares start trading at $8, then the underwriters can go out, start buying back shares in order to close the short position as well, but they're making at the same time a nice profit. This is how they cover the short position. They make a profit, and by buying back the shares, they do that with the view that they will stabilize the share price performance because they're reducing the supply of shares out there. What happens if the share price will go up though? If the underwriters that have sold initially 15% extra shares, and then they will have to cover the short position, it means that they will go out in the market, buy back the shares at a loss. Because they sold something at $10, maybe the shares now are trading at $12, it means that they're making a loss. This is when the over-allotment option comes into play. The over-allotment option is an option granted to the underwriters by the company to purchase an additional 15% of shares at the initial offer price. Therefore, if the share price will increase in the first few trading days, then they will exercise their option, which means that they will issue an extra 15% of shares at the initial offer price without making any loss, and they will cover the short position. So more or less, this is the IPO process and the different stages that we have. Obviously, in the interest of time, I'm not going to analyze in great detail each step, but this will give you a flavor of what is the process. Few statistics, just for reference. What are the largest stock exchanges around the world? Mainly the US, New York Stock Exchange and NASDAQ are the biggest ones in terms of market capitalization. And what we have seen lately is Asia, the Asia market and the Chinese stock markets having a big proportion as well. In terms of issuance, this gives you an overview, a historical overview of what has been happening in the IPO market globally in terms of IPOs and in terms of proceeds, but at the same time in terms of number of listings. The upper graph illustrates IPOs in terms of proceeds, you can see that 2021 was the best year ever in terms of IPOs, and this is also depicted on the lower graph in terms of numbers, 2021. But then if we look at the market share of different regions around the world, you can see that the US is gradually losing their market share, and who is gaining is Asia. And in Asia have included China, Hong Kong, and Japan. Therefore, currently, in terms of proceeds and IPOs, 54% market share is held by the Asia region. And in terms of numbers, IPOs actually, we have 46% in terms of Asia. And you can see that the US has lost quite a lot of ground because it's standing now at 9% overall. So these are a few basic facts about IPOs. What I will do next, because I think it's more entertaining, and this will give you also the opportunity to interact with me if you want, we'll go through a case study which is a real case study. It's a company that went public back in 2008. It's a shipping company, and we'll analyze different areas of the company in order to decide whether we're talking about a good investment or not. Obviously, this is a very interesting case because the company didn't do very well in the stock markets, and they lasted on the stock market only for a few months, and investors managed to lose their initial capital altogether. So this is the cover page. This is the cover page of the prospectus. It's a very informative page. I have highlighted here the basic information that you need. So we're talking about Britannia Bulk. Britannia Bulk went on the New York Stock Exchange, and they offered 8.3 million shares to the public at an initial offer price of $15. On the same page, we have also the option granted by the company to the underwriters, and that's why you can read up there, option to purchase to an additional 1.25 million shares. That's the over allotment option. Then another information which is important is that the underwriters have agreed to reimburse the company $500,000. That has to do mainly with the method of going public, which is something that I didn't mention earlier. Normally, the methods that a company will go public is either through a firm commitment or a best effort. Through the firm commitment, the underwriters will buy all the shares from the company, then try to resell it to the public. In other words, they are promising to the company a certain amount of capital. If they're unable to do so, then they will have to pay a penalty, you would say, back to the company. And this stands at $500,000. Apologies. Finally, we have also the members of the syndicate, Goldman Sachs, Bank of America now is Bank of America Merrill Lynch, Dalman Rose, and Oppenheimer. These are also the underwriters. Few words about Britannia Bulk. Was a major player in the Baltic Sea. They were operating in the dry bulk market. They had 22 vessels under control, including 13 dry bulk vessels, 5 ocean-going ice-class barges, and 4 ice-class tugs. They had also 6 vessels on order, 6 Panamaxes, to be delivered in 2009 and 2010. The additional vessels would increase the company's available tonnage by 72%. In terms of financials, the company earned a net profit in 2007 of $46 million on a revenue of $567 million and reported shareholders' equity of $72 million at year end. As we mentioned, the company raised $116 million to float on the New York Stock Exchange on the 18th of June, 2008. However, by the end of October of the same year, the company filed for administration in UK courts. What happened afterwards? Shareholders, they will try or attempted to recover their initial investment through the US courts. However, the judge eventually threw out the case, noting that all material facts had been disclosed in the original prospectus. And this goes back to the second step that we saw earlier, purely because the underwriters, they had performed the due diligence, meaning that all information provided to the public was accurate and reliable. So, could investors perform their own analysis and avoid losses on this investment? This is what we are going to do. A few strong points mentioned also in the prospectus. The company was a leading shipping provider in the Baltic Sea. They had a very good track record of strong, profitable growth. Their business model was also very attractive, providing flexibility to respond to market conditions. At that time, back in 2008, we had very favorable industry dynamics for the dry bulk shipping, and at the same time, the company was operating or collaborating, let's say, with very strong quality customers. And we'll see who the customers were later on. Finally, another strong point is that they had a very experienced senior management team and an in-house technical team. I understand that all the facts that we will present and we'll go through tonight, we will do that with the benefit of hindsight, but this will give you an idea of how an IPO can be analyzed and what are the different areas that someone could look into in order to make a more sound decision. First, we're going to analyze the use of proceeds, dividend policy, dilution, and proportion of company retained. There is a page in the prospectus which is called use of proceeds. This will lay out the main reason that the company is going public and how the capital raised by the company is going to be utilized. If we look at the use of proceeds page, we'll see that all of the capital that the company had at hand, including the capital raised by the IPO, was for repayment or refinancing of existing debt and for general corporate purposes. Remember that we said one of the main reasons that the company will go public is for growth purposes. Of course, it is for rebalancing leverage as well, but in the case of Britannia Bulk, the company was mainly using all the capital at hand in order to repay or refinance existing debt. At the same time, however, they had the intention to distribute dividends to shareholders in the amount of up to 30% of quarterly net income, and they expected to declare a dividend per share of $0.28 in November 2008. In terms of dilution, this is the extra premium that new shareholders, the public, will have to pay in order to have a share in the company. We have a dilution of $8.40 per share, which means that this is the extra premium that investors that were paying by paying the initial public offering price of $15. At the same time, there is a dilution for the new shareholders, but the existing shareholders are also gaining. Therefore, after giving effect to the sale of the new shares, the company will have a gain of $1.01 per share in terms of net book value. Finally, in terms of retained percentage of the company was retaining 70%. So the existing management team was retaining 70% of the company, which is also an indication that they believed in the company and they believed in the growth of the company. And that's why they weren't willing to give out more control out to the public. Next area, managerial capacity and underwriters. We're talking about a company that they had a very experienced management team, an in-house technical team, combined experience of 47 years in terms of the founder, chairman, and CEO of the company, and COO as well. 90 plus years of combined experience in terms of directors of chartering, CFO, and directors of operations. 30 plus years in terms of in-technical team experience. And in terms of underwriters, Goldman Sachs, Bank of America, they were very reputable in the finance arena. Even though they hadn't performed many shipping IPOs in the past, they were very experienced because they were working with other companies in other industries. So altogether, this is a very strong point for the IPO. Operating policy. As mentioned earlier, the company had very strong relationships with high-quality customers, stable base of well-known, long-standing customers as well. You can see the names of a few customers that the company was working with. Maybe a few names that you see up here that don't exist anymore, but you can see some big names as well up there. At the same time, they had a very aggressive chartered-in policy, which means that on top of the vessels that they owned and they operated, they were chartering in more vessels, or in other words, they were hiring more vessels in order to operate them, so they were paying a rent. Then they were operating the vessels in the market, and in terms of chartering vessels, the company was operating 45 extra vessels. So one could say that this is a very aggressive policy. In terms of the market that the company was operating in, you could see that there was a lot of reliance on the spot freight market, more volatile the spot market in comparison to the time charter market, where you can give out your vessel, let's say, at a fixed rate per day for a specific period, rather than performing a voyage, let's say it's time, and then next time you will have to seek employment for the vessel again. So as of March 2008, the number of chartering vessels, as I mentioned, was 45, and approximately 39% of the revenues was derived from the spot market. Now, in terms of fleet age, was the company operating a young or an old fleet? What you see up here is some statistics in terms of what has been happening back then in terms of the age profile of the dry bulk market. I have categorized the market into Panamaxes, Handymaxes, Handysizes, and the overall dry bulk market. You can see that the average age for Panamaxes was standing at 13 years. This is also the market that the company was operating the vessels that they owned. In terms of Britannia Bulk was operating a fleet with an average age of 12.7 years. So you could say, in these terms, the company was doing quite well. However, you can see also the very good market conditions that existed back then in terms of the average age that vessels are being scrapped, which stands at 28 years, which means that shipping companies that were willing to operate even older vessels, that they entail higher operating costs, because the market conditions that were very good, that still these old vessels, even though they had high operating costs, they were still profitable. Now, another area that we're going to analyze is the financial and shipping markets. What you see up here are two diagrams. We have S&P 500, which is a major stock index in the US, and gives you an idea of the general financial market conditions in the US. What we're trying to do here is capture in a very simple way the sentiment of investors out there, in a very simple way, by measuring sentiment in terms of the 60-day cumulative return. In terms of financial markets and S&P 500, that was standing at minus 0.76%, which means that investor sentiment was quite neutral. However, if we go to the right-hand side, this depicts the performance of the Baltic Dry Index. This is an index that illustrates market conditions in the dry bulk market. We can see that the sentiment for the dry bulk market based on BDI was standing at approximately 22%. So one could say that this is a very optimistic view that investors had in terms of the shipping market. However, what we have to remember here is when we talk about sentiment, sentiment is a contrarian indicator. Therefore, when everybody is feeling euphoric, for example, we will need to go on the other side. We'll have to do the opposite. Or whenever investors are feeling pessimistic or overly pessimistic, we'll have to do the opposite, which means that we'll have to enter the market. So let's keep that in mind as well. Another area that we can analyze in terms of the particular company is what has been happening in terms of volume. Volume in terms of IPOs and volume in terms of follow-on offerings. For 2007, which was the year prior to the company going public, we could say that this was a very hot market in terms of shipping IPOs and in terms of follow-on offerings by shipping companies. 9 companies managed to go public for the first time and raised $2.01 billion, and companies that they were already listed on a stock exchange in the US, they managed to raise $3.42 billion through 29 issues. So one could say that this was a very hot market. However, 2008, that was the year that Britannia Bulk went public. That was a very quiet period, and that's why we call it a cold period. Only one company, one shipping company, managed to go public for the first time, and they raised $0.32 billion. And only 9 companies that they were already listed managed to raise further capital through an equity issue and raised $1.34 billion. Therefore, we have this period as a cold period for the IPO and follow-on offerings. Next, what we have here, without going into much details, the technical details of what you can see up here, what we're trying to do here is identify the cycle phases. As soon as you are able to identify the cycle phases, then you can measure also the duration of the phases, and you can measure also the amplitude. What is the capital appreciation or depreciation that you may have throughout the different phases? Gray shaded areas on the graph that you see here. Again, we're looking at BDI. This time BDI is on the left-hand corner, S&P 500 is on the right-hand corner. Gray shaded areas represent contraction periods on the particular indices. We are using a very famous algorithm here, which is called the Bright-Boson algorithm. It's an algorithm that the National Bureau of Economic Research in the US are employing as well in order to decide whether the economy has entered into a contraction. It does a very good job in identifying the different peaks and troughs that you will have. That's why you can see that the gray shaded areas are laid over during periods of contraction. And in this way, when we measure the different cycle phases that we have, we can measure also, or we can calculate or have, let's say, figures in terms of duration, how long on average a contraction period can last, or how long an expansion period can last, and then the amplitude. What is the percentage gain or loss that we'll have during the different phases? What you see up here, starting from the left-hand corner, we have BDI. According to the algorithm, May 2008 depicted the peak in the market. Obviously, the peak is at the top of the market, the trough is at the bottom. May 2008, peak in the shipping market. Red dot represents the time of Britannia Bulk's IPO. If we look at the statistics that we have for the shipping market down here in terms of duration, we can see that the contraction can last on average 18 months. May 2008, peak in the market. On average, we would expect that this contraction period will last for 18 months. Therefore, we still had plenty of time ahead of us that the shipping market could be in a contraction phase. At the same time, during contraction periods, BDI will incur a loss of 62%. Therefore, you can see that this is a big number in terms of capital loss that we may have in the shipping markets during a contraction period. Therefore, in terms of timing and shipping markets, we could say that Britannia Bulk's timing was not great, purely because we're already in a contraction. We expect this to last for longer, and we're expecting as well a 62% reduction in capital in terms of contraction period for the shipping market. Turning to the right-hand corner, we have S&P 500. S&P 500 had a peak in October 2007. Britannia's Bulk IPO was in June 2008. Therefore, if we look at the duration for the contraction period in S&P 500, we would expect that to last for 17 months. Therefore, we still have some months ahead of us that the financial markets in the US would be in a contraction. And at the same time, the general stock market index would be expected to lose 32%. Again, in terms of timing and Britannia's Bulk IPO, that was not great. Any questions that you may have? No. Then we have an analysis here in terms of financial health of the company. What we do here is we compare the financials of the company in comparison to the industry average. The statistics that you see up here are calculated based on 50 IPOs that took place prior to Britannia Bulk going public. I have laid out a few ratios that we may look into: working capital over sales, the efficiency ratio, profit margin, return on assets, current ratio, interest coverage, and gearing. The only ratio that Britannia Bulk, one could say, was outperforming the industry average was the working capital over sales. Therefore, you can see here that the average was standing at minus 90%, whereas Britannia's Bulk working capital over sales was standing at 12%. That's 20% above average. For all the other ratios, you can see that Britannia Bulk was underperforming the industry. Therefore, the financial health of the particular company was not great as well in comparison to the industry. And another analysis that an investor can do is by looking at whether the issue is going to be underpriced or overpriced. Underpricing, it means that the underwriters are pricing the company or the issue or the shares of the company at a price which is lower in comparison to the market view. And that's why, for example, a company and in this case, the company was priced at $15 per share. If we had underpricing, we would expect the price to increase. That means that we had an underpriced issue. On the other hand, we have overpricing. If for this particular company that was priced at $15 per share, for the first few trading days, the share price will decline, which means that the underwriters overpriced the value of the company. Why underpricing is important? Because this is something that can make investors money as well in the first few trading days, because they will buy, let's say, this particular company at $15 per share, and thereafter, maybe during the first week or the first 2 weeks, they will see their investment appreciate purely because the share price will increase. There is a method that you can utilize to predict the underpricing of particular companies without going into the technicalities. What you see up here is, again, a sample of 50 companies, the probabilities of underpricing that we have for 50 companies. What constitutes, let's say, an expectation that a company will be underpriced or not? We have a cutoff value there based on a research paper of 2008. 35% thereafter, any probability that is above the 35% cutoff value, it means that the issue is expected to be underpriced. Anything that is below the 35% cutoff value, it means that the issue is going to be overpriced. Or in other words, we expect the share price to fall in the first few trading days. Where Britannia Bulk stood, 0.82% probability. That is a very low probability and way below the cutoff value that we have here of 35%. As such, one could conclude that we would expect Britannia Bulk shares to decline in the first few trading days. Finally, analyzing the project, because we said a company needs to have a very good project or a very good story to sell to investors. For the period 2004 to 2007, an average per year cash from operations of $20 million was generated. However, the company had also high capital expenses, $69 million. That is 3.3 times more than what they were generating. How this was financed, because this is very peculiar, this financial requirement was almost met by entirely borrowing money all the time. That's why they had via regular rounds of additional debt. Turning now to the project that they had, the 6 vessels on order to be delivered in 2009, 2010. They had committed for these 6 vessels $356 million. This is the money that they would have to pay on delivery of the vessels. They had put aside $71 million in terms of deposits for the particular vessels. Therefore, what this meant that they had a minimum CapEx spend of $142 million for each of the next 2 years. Now, by means of comparison, Britannia Bulk generated $52 million from operation in 2007, and they were expecting to have capital expenses of $142 million for the next 2 years, each year. However, due diligence again, the company and the management of the company explicitly acknowledged that fact. And they stated that they will need to come back to the capital markets to raise additional capital. And at the same time, they also mentioned the serious consequences that they will have if they fail to do so. Therefore, investors, they were informed about that as well. However, what we can conclude is that from the significant historical capital expenditures relative to the operational cash flow generation that the company had historically, there was a high probability that Britannia Bulk would not be able to meet the commitments that they had put in place by ordering the new 6 vessels. So let's put everything together. What we have here is the valuation table, and we will analyze here, or we'll see all the areas that we went through, starting with the use of proceeds and the dividend policy. I have a minus and a plus here purely because in terms of use of proceeds, the company was raising capital for refinancing or repaying existing debt. That's why I have a minus. However, at the same time, in terms of control of the company, they were willing to keep 70% control of the company, and that's why we have a plus. In terms of dilution, dividend policy, they were expecting to distribute dividends. Apologies for that. That's why I have a plus. Dilution and proportion of company retained. In terms of dilution, extra premium that investors had to pay, $8.40 per share. And at the same time, we have a plus for the control that the management team retained, 70%. Management team, very experienced, as we saw, very experienced management team and in-house technical team. That's why we have a plus. Operating policy, I have it with a question mark, purely because the company, even though they were working with very reputable customers, at the same time, they had a very aggressive chartering policy. And as we mentioned, they were chartering in 45 vessels. That's why I have a question mark here. Underwriters, fleet age, fleet age. The company was operating a relatively old fleet in comparison to the industry average. In terms of underwriters, very reputable. As we mentioned, not many shipping deals that they had done in the past, but very reputable altogether in the finance arena. Financial and shipping market sentiment, neutral sentiment for S&P. That's why I have a question mark, which means that this could go either positive or negative, which means that investors could feel optimistic or pessimistic, so we cannot really judge what will happen next year. However, in terms of shipping market sentiment, investors that were feeling euphoric, 22%, 60-day cumulative return, and that's why I have it here with a minus, taking into account the contrarian nature of sentiment. Shipping IPO and secondary offering markets, hot IPO and secondary markets in 2007. However, 2008 was cold in terms of both IPOs and secondary offerings by shipping companies. Finally, in terms of financial metrics and probability of underpricing, very poor financial metrics compared to the industry average, and extremely low probability of underpricing for the particular company. Finally, the growth plan, the new building program that the company had in place, we saw that the company had high historical and committed CapEx relative to the cash that they were able to generate in the past, and at the same time, they didn't have the financial commitments in place for the 6 new building vessels that they had on order. So what happened? First day closing price, shares of Britannia Bulk dropped to $13.85. That means that the company had a decline of 7.7%. indicating that the issue was overpriced, and this was also expected by the probability of underpricing. So we're talking about an overpriced issue. Investors, in terms of investors, we'll go to that at the end, but in terms of price performance, the price never traded above $15, which was the offer price. If you will look at the first few weeks of trading, one could say or could argue that the underwriters tried to stabilize the share price performance, and that's why you can see the share price ranging between 14 plus and $12 for 4 weeks. That's the amount of time that underwriters have at hand in order to try and stabilize the share price performance. And that's why I say that probably the underwriters tried to stabilize the share price performance. However, they were unsuccessful in doing so. What happened for investors? In a matter of only 4 months, investors managed to lose 100% of their capital. So this gives you an idea of how companies can raise capital through equity offerings, and it gives you also an idea through a case study in a very brief presentation what are the different areas that one could analyze in order to make their own analysis in terms of particular companies that they go public. So with that, I will finish. I would like to thank you very much, and I don't know if you have any questions. Any questions that you have about the scholarships or the presentation, more than welcome to answer. I don't know if you want to do that now or if you want to do that over drinks and some food that we have. It's up to you. No questions? Please. They were based in the UK, in London, Trafalgar Square, to be specific. And that's why they filed for UK administration, which means that they were filing for bankruptcy, because we have the difference when a company will go public. They can do that depending on where the company is. They can do it either through the UK court in the case of Britannia Bulk, but a lot of times you can see companies looking for protection in the US under Chapter 11. No. I understand that maybe there were a bit of technical terms that I used here, but hopefully you get the idea of the different areas that you could look into in terms of equity financing and IPOs, because this is a general and broad topic on finance. No, the company was listed on the New York Stock Exchange. Obviously, this gives you the ability of more liquidity, because we have to remember that when a company will go public, they need an underwriter. The underwriter is the player that will create the demand as well, because they have been working previously with different clients, so they can bring the clientele, they can create the demand. However, at the same time, the company needs to offer to investors something good. New York Stock Exchange has more liquidity in terms of more investors, and this is something that companies are looking for when they decide on which stock exchange they're going to be listed. For example, they could go also for a stock listing in the UK market, LSE, London Stock Exchange back then. However, the liquidity for the London Stock Exchange is thinner in comparison to the New York Stock Exchange. In other words, for shipping companies in particular, the biggest stock exchanges are the New York Stock Exchange or the US stock market and the Norwegian stock market. The difference between the two, one of the main differences between the two is the type of companies. So companies that they have growth potential, companies that are quite small and they want to grow, they will go most probably for a listing on the Norwegian stock market, purely because investors there, they do not care about the income generation. The income generation in terms of distribution of dividends, what they care is capital appreciation on their investment, and that's why they will go for growth companies. However, in the US, most of the investors, they will look for the income generation through the distribution of dividends. But these are the two main markets, let's say, for shipping companies.
In the US versus the UK?
In essence, not really. The terms are the same. So, for example, I can tell you about Chapter 11. What happens there is the company will file for Chapter 11 if they want to be protected from the creditors. However, there are some advantages and disadvantages there. The company will be under protection. At the same time, major operating decisions for the company cannot be taken by the company. It is the judge that needs to approve all decisions by the company for as long as the company is under Chapter 11 protection. That can create a problem because the company is still operating. Even if the company files for bankruptcy, the company is still operating. What they are trying to do is restructure the debt in the capital structure so they can re-emerge with less debt so they can continue operating. If you have the judge approving all the major decisions that the company wants to take, that can create delays, and maybe the company will miss some profitable opportunities. UK administration is the same like Chapter 11. Obviously, you have other option is the out-of-court settlement. When a company needs to restructure the capital structure, you have the out-of-court settlement and you have the pre-packaged bankruptcy. There are some advantages and disadvantages between Chapter 11, pre-packaged bankruptcy, out-of-court settlement. But the main one is the unanimous consent that you need from all creditors in order to agree on the reorganization plan and the restructuring of the company. For Chapter 11 and the pre-packaged bankruptcy, you do not need unanimous consent. But for the out-of-court settlement, you need unanimous consent from all creditors. You need majority or the big creditors, let's say. If the big creditors, that they hold most of the debt of the company, agree on that, then everything will be fine. They can go through the restructuring or the reorganization plan. But this is something that they cannot do in the out-of-court settlement. Obviously, the out-of-court settlement will save the company time and money. Any other questions? I don't know how we're doing about with time, Konstantina. Are we okay? So, thank you very much again, and pleasure to have you here tonight.
This moment